Good afternoon, everybody, and thank you for taking time out of your busy schedules to join me here for this special presentation. My name's Tom Ahola. I'm one of the advisors and real estate agents here at Marshall Reddick Real Estate, based out of the Newport Beach office. And today we're talking about multi-unit investing in Southern California, a topic that I'm extremely passionate about. It's actually something that got me into real estate to begin with. There's tons of opportunities out there. It's kind of glamorous. It's kind of fun to own, but it's also something that can be extremely lucrative if handled correctly. I'm going to give us a couple minutes. I see there's a couple stragglers still coming in. Just wanted to make sure you guys knew you were in the right place at the right time. So I'll give it about another 60 seconds or so for people to cruise on in, and I will be back shortly. Okay, we did get quite a bit of flow of more people, so I'm just going to go ahead and get started now. Looks like we've got a majority of people who are going to attend. Again, my name's Tom Ahola. I'm one of the realtors and multifamily specialists here at Marshall Reddick Real Estate. There's my contact information. There's going to be plenty of spots, however, so don't feel the need to write it down just quite yet. Again, welcome and thank you for taking time out of your busy schedules to join us here. For those of you who don't know, usually people who are signing up for these webinars are already Marshall Reddick clients, but if it's your first time here, let me tell you a little bit about us. Marshall Reddick is a real estate, property management, and private lending institution. We've been doing real estate for quite a few years, a couple of our clients since the 70s, 80s, 90s, I mean, even later, I mean, long time. But our business model has adapted and grown accordingly to where we cover all facets of investment real estate. That is real estate brokerage, so helping you buy and sell real estate in-state, out-of-state, anywhere. We can help navigate 1031s, we can help portfolio planning in multiple different locations, or whatever you're really looking for in your real estate investment portfolio goals, we can assist with. We also do property management, which we will be alluding to quite a bit in this presentation today. Property management is crucial when it comes to owning investment properties because you can easily make or break a deal accordingly. If you have an extra month or two of vacancy, that could be your year's whole profits. So it is one of the keystones to owning any investment real estate. Anybody that owns real estate will have to agree. We are also a private money lender, which I will also allude to in today's webinar, because the multifamily deals really do take a trifecta of all three of these things. So private money lending, that's, you know, if you need a construction loan, a bridge loan, renovation loan, anything that you would really need private money for, we do here at Marshall Reddick. We do even have a long-term hold. So we also have what's called an investment fund. If you have any questions about that, it's actually quite good. We just paid out last quarter. It pays out quarterly. 8.75% is the annual goal of what we're kind of working towards, which is pretty awesome. I invest quite a bit of my own funds in there as a great place to park some capital. You only got to season it for about a year. It's all real estate backed, it's all real estate first position mortgages. So super safe, super secure. I get a lot of people I'm talking to right now that are saying, hey, I want to wait a year. Perfect. You only got to season your money in there for a year. That's all I'm going to talk about right now. If you have any more questions about that, it's actually quite interesting. Great place. A lot of people are parking their money with uncertain real estate times right now. Little, you know, word for Marshall Reddick. We make it possible to invest in real estate in carefully selected areas of the United States. Our firm provides education, investments, and in-house professional real estate services, along with access to vetted and necessary resources such as contractors, lawyers, insurance agents, and CPAs. And boy, oh boy, do we have a lot of contacts for all of those people. Definitely a great place to be if you're looking to invest anything in real estate. So feel free to reach out if you have any questions regarding anything regarding any part of real estate investing. We can probably get an answer for you. Quite a few years of experience and, you know, an enthusiasm to help all of our clients. And without further ado, what to expect. All right, so I wanted to go over the basics. This is actually a presentation that I have developed myself. So it is a facet of real estate, as I said prior, I'm extremely passionate about. So things we're gonna cover is really just the surface level basics. Well, as basic as I would say, quite complicated in certain facets. So I'm gonna try and keep it semi-slow. But let's just say we're not going into the 14-page spreadsheets on multifamily investments today. That you'll have to schedule a consultation for the 2.0 presentation. But questions I'm going to answer: why multifamily? Secondly, what is the cap rate? I use cap rate as an easy metric for, you know, valuing these properties against each other. Of course, you've got all kinds of other metrics. So, you know, I get everybody asking all the time, hey, what about this? What about that? Of course, yeah, those are metrics we also take into account, but cap rate is the easiest way to translate it. Why value add? That's a big kicker that wasn't disclosed in the description, but we actually look for value add multifamily real estate. What that looks like, you're going to learn. Buyer or seller representation, what that process looks like. How we find 3 to 8 unit properties. Now, it says 3 to 8 mainly because those are the areas I like to stick around personally. For investors that are coming into it. Once you start getting a little bit bigger, it starts getting a little more complicated. Not to say we can't handle that, but I just like to use these formulas in this presentation for 3 to 8 unit buildings. Property management and why it's important, financing, and a recent case study of a property that I actually personally listed and sold in January to one of our clients that came into a webinar just like you guys. So that'll be an interesting one. It's actually a great little neighborhood. I live and work there, so we'll go over that a little bit later. All right, and now what we expect of you. I can't tell you enough that I want you guys to engage. I want you to sit back, relax, and learn, okay? A lot of people are just serial attendees. We see them time after time again, and they just sit back and listen and kind of pay attention. But what I'm tasking of you, I'm asking for a personal challenge for you to actually take extensive notes. I want you to learn today. I am here to teach you the different new things that maybe you're looking to learn about real estate investing. The clientele that I usually see coming to this presentation sometimes already owns a couple properties or maybe owns a multifamily property that they've inherited, and they're looking for some more answers. So there's going to be a ton of data, a ton of information. Take notes. And also ask questions in the chat. I most likely won't be able to answer them real time, but I do have a section for FAQ at the end. And if again we run out of time at the FAQ, I will personally take it upon myself to look through those questions and reach back to you either on the phone or via email, most likely on the phone. So I personally like to connect with every single person who attends just because we like to help you with your real estate investment goals. Any more in-depth questions, write them down, schedule a consultation. We'll be able to get into the more like the nitty-gritty. Like I said, this is presentation 101. 102 is a consultation where we can sit down and I can really help you understand the ins and outs of multifamily real estate. Last thing, be ready to scan QR codes. It's something new that we've been kind of throwing in there. I've got a couple links to a couple pages that might be of interest that you can kind of scan on your phone, pull it up. The other thing I ask is that you wait until after the presentation to really start digging into it. I just want you to have those links now. There will be a ton of information we'll be going over. And like I said, this is merely the basics. So without further ado, here we go. Raise your hand if you're planning on taking some notes today. I want some engagement. All right, Andreas, he's ready. All right, guys, let's go. All right, and again, like I said, consultation here. That's a QR code for the consultation page. If you want to schedule the consult now, feel free to zap that, kind of get the page pulled up, but there's going to be a couple other places further along. And here we go. Again, a little bit about Marshall Reddick. I'm also an advisor here, so that means I help manage portfolios in-state and out-of-state. I personally specialize in the more in-state stuff, but I have plenty of clients who own real estate in Texas, Tennessee, Florida, Idaho, Arizona, a couple of different places. Actually, a couple more sprinkled across the US as well, not in these markets that we have referral networks for. But you know, these are our main markets that we operate in, but mainly today we're going to be talking about the LA and Orange County market. All right. Now, biggest question that anybody's going to ask today: why multifamily and why value add? Well, here's your answer. Number one, the economies of scale. What does that mean? Multiple doors, multiple rents, growing at the same pace. You really just have to buy one property versus 4 properties to get to the same amount of doors. And I've got an equation a little further on that'll break down why. Price per door is substantially lower than SFR. Once you start getting into the multifamily realm, you start looking at properties as doors, you know, so like how many doors do I own? Yeah, multifamily properties will bring a little bit less than a comparable size unit that's a single family property. However, the price per acquisition is substantially lower. And of course, you've only got one tax bill, one utility bill. It keeps it more consolidated. It helps you scale your portfolio substantially quicker than buying one single family at a time. Number 2, less competition. This is actually one of the reasons why I personally got very invested into the multifamily market, not just as a person who's selling it, but as a person who's buying it, because there's a lot more opportunities. Not to say that there's, you know, it's just walking through a field and picking up daisies everywhere. You're definitely still going to have to dig for them, in fact, I dig for them and I find these deals. But they are out there more so than single family homes. And anybody who lives here in the Southern California market knows that SFRs, single family residents, just don't make sense as investments in Southern California. Unless you're getting like a, you know, heavily distressed property, or you've inherited a property. When you actually get down to the nitty gritty of, I'm going to buy a new single family house and turn around and rent it out, you're probably not going to break even. Multifamily real estate, totally different story. A lot more moving parts, but again, the more moving parts means less competition, less people who actually know how to fully capitalize upon these deals. Number 3 is my biggest, enjoyment point of part of these deals is forced appreciation. Anybody that works in real estate knows what forced appreciation is. It's, you know, like flipping a place, raising rent, decreasing expenses, pretty much anything that you can do to increase your NOI. And when you increase your NOI, your net operating income, it increases the value of your property substantially. I had a client whom I helped purchase a triplex, actually a very, very good friend of mine, and we're going to be doing the case study further in the presentation. And it was his first piece of real estate that he bought. I assisted him on the purchase in Torrance, the town that I grew up in. Triplex, purchased for $1,625, renovated the front unit, raised it to market rent, negotiated with the appraiser, who did the same exact equation that we're going to be talking about today, which increased the value of the property, and it appraised for $195 about 90 days later. And that was a great conversation, because I remember sitting down with him and he says, did I just make 325 grand? I was like, yeah. Yeah. Forced appreciation is a great formula, and we will definitely show you how to increase value. What that looks like is renovating, increasing rents, and refinancing to pull out that equity, or just let it ride. I advise a lot of people right now, if you keep your payment low, you get your cash flow high, let it ride. We're all going to be hitting that refinance part of the market again in the next few coming years. You know, the low interest rates are no longer here, but what that also means is prices are starting to come down. So take that with a grain of salt. You know, if you want to know more about the real estate market and what's going on, schedule a consultation. You know, we can have a great real estate conversation and take it from there. So without further ado, economies of scale. this is what I was talking about. So building A is we'll just call it an example of I've got my number there. It's a fourplex, right? Purchase price of $750,000, okay? I alluded these prices to about Texas prices just to keep it a little less complicated so we're not jumping up in the millions. But this is about an average of what we're seeing. Purchase price about $750,000, you get 4 doors, right? And just for comparison, we'll say these are 4 2-bedroom, 2-bath units, okay? So your price per door, when you divide 750 by 4, is $187,500. Each of these 2-bed units is bringing in $2,000 a month, and you only got 1 property to maintain, 1 roof, 1 sewer, 1, any of your issues you're going to run into as a property manager, you've only got 1 of them. Versus a single family home. Say you bought this single family home for about 250 grand, you get 1 door, you get 1 unit. That makes, I did my math wrong. Forgot that one there. Price per door, $250K. Gross monthly income, as I said, it's going to be a little bit higher than owning a fourplex, and you're going to be earning a little bit more income. However, the doors needed to equate to the same $8,000 a month, you would have to buy about 3.55 properties. I know it sounds a little weird, but to get the equivalent amount of income, you're going to be paying $887,000. A little more expensive, but when you actually factor in the fact that when you buy the other place, you're also exponentially growing your rents as they go up 50 to 100 bucks a month, it all really outweighs owning 3.5 single family homes versus 1 fourplex. All right, capitalization rate. Some of you guys are aware of what capitalization rate is, but we're going to be going over the basics, and it is one of the most commonplace things that investors use to compare properties. And why this is very important, you will see in the future, because you not only get the valuation of a place if you're going to sell it, but it also is the way that all lenders work with income property. You can do a valuation through cap rate if you have an income producing property, okay? What that looks like is cap rate equals net operating income divided by purchase price, okay? Easy metric. You can measure the income earned by a property with a simple equation, right? And again, we're going to be going like building A, building B. So orange is building A, gray is building B. Okay, cap rate reversion. This is what I was just talking about, where you can price any property accordingly by using the desired cap rate, okay, divided by, or the net operating income divided by the cap rate, to get the future value of the property. Again, like I said, take some notes. There's going to be a ton of notes. We're going to kind of do this equation forwards and backwards 2-3 times, and we are going to really get into the weeds here in a couple slides. But I want you to kind of sit down, pay attention, and look at what we're doing here. Does value pencil out to the seller's desired sales price? Usually yes, because this is the way that the markets operate. How do you calculate annual net operating income? Exactly what we're going to talk about here. Oh, pardon me, skipped a slide. There we go. Here is net operating income, okay? So what you do is you take your actual rents, your gross rents, so the actual income the building is bringing in. As you see the breakdown here, you've got 1 unit of a 2 1/2 bath bringing in $1,000. Another unit, 2.5, a 2 1.5 for another 1,000, and then 2 2-1s bringing in $950 each for a total of $2,950 times 12 for our gross annual rents of $35,400. Next, we always account for vacancy. Vacancy is something that will save your bacon. A lot of people think that you just operate gross what's on the books. No, account for vacancy, because chances are you're going to have some. 8% accounts for about 1 month's vacancy per year, okay? You may have a great year or a great run with a tenant, and maybe they stay in for 3, 4, 5 years, and that's awesome. You know why? Because consider that $2,800 a little icing on top. That's your bonus, right? But for now, for our equations, always account for vacancy. Okay, that takes us to an effective gross income of $32,568. For our operating expenses, we have property taxes. You can't get out of that one. Property insurance, you can't get out of that one. Utilities such as water and sewer, you got to pay for those. Miscellaneous overhead, always throw in a fudge factor. Maintenance, leasing, and management for a total yearly cost of $12,293. That's how we get our NOI. So again, we take our gross rents minus all of our expenses, and that's how we land at our net operating income. Now, NOI is an easily adjustable number because, of course, we can either number one, cut expenses. This place is pretty slim, but sometimes you get a building where you've got way too high of expenses. The way you can trim that is maybe, say you've got expensive trees in the front. Well, chop them down. Maybe not beautiful trees, but say you've got problems, you've got overgrown weeds, and the gardener's got to come back and he's charging you 3 times the amount of what he would charge. Well, cut that expense. Say you've got a high water bill. Hey, what's going on here? Hey, we got to look into that. Maybe there's a leaky pipe somewhere costing you an extra $1,500 a month. These are all things that we look at. Kind of, there's a place that a building should be, and we help you really lean that down to increase your net operating income. All right, and if you remember the equation, you take your NOI over the cap rate and you get your value, right? So what that looks like is, here we go, boom, right there. So that's our future valuation. We take our gross rents minus all of our expenses to $20,275 for an annual net operating income of, just like I said, 20 grand. Divided by your desired cap rate. For this neighborhood, we're using a 6% cap rate, and that's how you get your desired value. So again, there's the equation, NOI divided by cap equals value. So 20,275 divided by 6 equals 337,917. And for those of you that are following along, the easy way to put that in your calculator is 20,275 divided by 0.06, and that's how you get your valuation. I do it for every property that I look at. It's just the simplest math equation to get your cap rate right out the gates. Now, pardon me because I put a slide in the wrong place, but cap rate reversion, okay? Properties can be valued by an average neighborhood cap rate that properties trade hands at, and this is so true. By neighborhoods that you look at, you can look at LoopNet, you can look at any of the major real estate, networks or data collection places. Every neighborhood has a cap rate that properties trade hands at. Now, sometimes that's a general cap rate. If the neighborhood's a 6%, sometimes people want to sell something quicker, so they'll sell it at a 6.1% cap rate or a 6.2% cap rate, and that brings a lot of investors in. Or if somebody's a little hard-headed, they'll say, hey, I could bet you I can get a 5.75% cap rate, and they'll sit on the market for a long time. That's just the way it goes. If something's going to trade hands at a 6% cap rate for the neighborhood, that's what people buy things for there. Each county, city, and area sells at a different cap rate valued by comparable sales that have closed in that area. What that means is if 10 other buildings sold at a 6% cap, if you're going to be listing and selling a building, it should be sold at a 6% cap, period. For example, well, there you go. That's my next line. This data is collected by recent sales and historical sales data, so they go back and check it out. Something else to take into note, cap rates will change according to markets. So that is something that is important to know because, of course, rents stay the same. But if prices go down because of interest rates, cap rates will go up. However, the Southern California market has historically stayed consistent in cap rates because rents don't really go down. And if you really notice in the coastal markets, a lot of the markets that I like to operate in, a lot of nice A-class neighborhoods. If you're curious what A-class is, look up the Marshall Reddick Property Rating ebook. But nice, solid A-class neighborhoods where you're going to have a nice, steady appreciating asset, and not only is appreciating asset, but you have nice, steady appreciating rents. So you're not going to fluctuate like a lot of places where. Every presentation too, I get a couple people coming in here. I only buy at 8 cap or 10 cap or whatever it is. Yeah, but you're buying in Ohio or random Rust Belt areas, and you really get hit by the swings. And what that means is rents will go up, rents will go down, prices will go up, prices will go down. Versus owning one of these property, they're what I would like to call kind of like brick and mortar properties. They're always going to be consistent. If you buy one now and you retire in 30 years, it's still going to be bringing in at the very least what you've paid for at, but in actuality, it's going to be increasing 5 to 7% in rentals per year. I also like to translate like this. You buy a fourplex now, when you retire, just that building will give you a 6-figure income. Let that sink in. If you buy a fourplex now and you hold on to it for 30 years, when it comes time to retire, you will be netting at least 6 figures from these buildings. So regardless of your cash flow, whatever the situation is, it's pretty dang exciting to know that. You just need one, but I want more. So start with one, grow it from there, because you can easily force some appreciation and some equity in these properties. All right, so now again, pull out those papers because we're going to get a little bit into the weeds here, but it's actually going to be quite simple. So something else to take into account is, I know I said buildings always trade hands at 6% cap rates in neighborhood. However, if you find a value add building, of course, it's not going to be a 6 cap if it's only bringing in half the amount. Otherwise, the building would trade hands at about 150 grand, and it won't, because there's still an inherent value in the property, even though it's distressed, even though it has low rents, even though it has issues and things to deal with the property. But that doesn't mean you still can't get a deal. This is why I wanted to explain cap rate very well, because again, a lot of people get stuck on cap rate, but it's not just all about cap rate. So we've got building A and building B. Building B has a substantially lower cap rate. The market average is 6. Why is it at 4? Because of the net operating income. If you look, building A is bringing in $20,275. Building B is only bringing in 13 grand. However, if we look at building B, say we were looking at the composition for your imagination purposes, we like to see that building B is actually capable of achieving higher rents. Say building A is a bunch of 2 beds, building B's got a bunch of 3 bedrooms, okay? And people do this all the time because a lot of realtors, a lot of investors, a lot of people, sometimes they've got multi-unit properties, they don't know how to list them effectively. That Torrance property that helped my client and friend purchase earlier had actually listed it incorrectly, and it was a triplex that was listed just like this situation where they said, hey, other triplexes in this neighborhood are selling about for this price. What they didn't look into is the fact that it was 3 1,600 plus square foot large townhome style unit, 3 bedroom, 3 baths, and we bought it for the same price as another building that had all 2 bedroom units. Now you tell me what building's going to be earning more money, and that's your answer right there. So here's what we're looking at, and this is what I'm talking about with value add multifamily property. After a few months of fine tuning with Marshall Reddick's team, we can increase that NOI, and that is start to finish what we do. We've got the in-house management to deal with, if there's any vacancies, to fill the vacancies. If there's some work that needs to be done, large or small, we handle everything in-house, and subsequently we increase the value of the property. And remember, if the buildings in the neighborhood sell at a 6% cap rate, that still applies if you increase your net operating income. So now when you look at building B, we took the income from $13,000 to $27,000. Say building, like I said, building B's maybe has 2 vacancies and under rent for the other ones. We've renovated, filled those units, and now building B is performing substantially better than building A. Now what you do, again, NOI divided by cap rate equals your sales price. So 27033 divided by 0.06 equals 450,556, 450 grand. Okay, for a net equity gain of about, what is that, 120 grand, 113 grand, whatever it pencils out to be. Something else to take into account. If you're just saying, hey, I just want to buy a building B when it's done, you can't. It's been my observation of the market, and I look at any building that comes on the Orange County or Los Angeles market that's over about 3,200 square foot. I see every building that pops up, and every one of these buildings has either under market rent, has some maintenance that needs to be done, and that really pretty much just boils down to nobody sells performing assets. okay? And, you know, maybe if you see one, that's a one-off. That happens every now and again. But there's a reason why nobody sells them, because they're gold mines. They are absolute gold mines, and nobody wants to give one up from their portfolio if they have one. But to get one, it's not going to be easy because you got to put the work in. But we're offering you a shortcut here because we're doing the work for you, mainly because I like doing it so much. So this would be generally a venture capitalism kind of situation where you would have to get in a group of investors and somebody's got to do the work, but we're offering that for you for free just because we want to do it as a service. We've got a lot of clients that have bought single family properties over the years. They've got quite a bit of equity and they're looking to 1031 or consolidate into some kind of, you know, luxury or A-class or quality multifamily real estate that's really going to provide them that generational wealth, you know, versus passing down a portfolio. Hey kids, here's a fourplex. By the way, it's bringing in about 150 grand a year. Have a nice day. So what does that even mean? All right. Did I just make a 108% return on investment? Your answer is yes. Like I said, you've got that net equity gain of about 113 grand. And again, your ROI is your total profit divided by total investment capital divided by years held. This I would estimate would be about a 6-month turnaround because of the situation. Like I said, you've got 2 vacancies. That's not a difficult thing to adjust. You know, 60 days of renovations, maybe 90 days. 60 days of 45 days of vacancy until we put a tenant in both of those units. And I can say it's a very conservative estimate to turn around a building in 6 months, just like this situation. In actuality, this is something that we've done before and something that we can do for you. And here you go, you get a little sneak peek of what I was explaining to you. We've got spreadsheets, all kinds of spreadsheets. I've built a lot of these for these different situations. And what's cool is this is an actual situation that would pencil out that, like I said, I used about average numbers using a 6-month hold Marshall Reddick private lending loan. Let that sink in again. This is using an in-house loan to buy a property in-house with an agent to use in-house management. So I can't imagine an any easier solution, right? You're not navigating 3 different people trying to coordinate and put everybody together. We already have all the communication. If I have a question for property management, I pop up from my cubicle and ask one of the guys on the team. If I've got a question about private lending, I pop up, ask one of the guys or gals on the team, and we get it figured out real quick. All right. So what does that look like? Here is the rate sheet. Again, I use the example of a 6-month hold renovation loan at an 80% of acquisition plus renovation funds. What that means is you put 20% down and Marshall Reddick pays for the renovation costs. It's actually an IO loan, which is phenomenal because that keeps your payments low. And then what you do on the back end is you actually would refinance out. If it's a 4-unit building, you get a conventional loan where you would actually get more favorable rates because lending on these buildings operates from net operating income. Or if it's a 5-unit plus, you can get a private loan from us and we can operate it that way. Again, you got a QR code here. This will take you to the private lending page. So snap a quick scan of that. If you have any questions to do further with what we got going on with the private lending department. And here's a little bit more information about what we do and why our private lending is great, because we're truly asset-based financing. So doesn't mean you have to qualify, doesn't mean your wife has to qualify, doesn't mean you have to look for a co-signer to show a certain amount of income or XYZ, right? If you've been doing real estate deals, you have the knowledge and experience and you have the right property. We are truly asset-based. We will look into it and we will most likely get you a loan. We've got reasonable fees and interest rates, quick closing, and we do waive the appraisal for 50% or under loans. Again, renovation, bridge, new construction, anything you can check out, scan that QR, you can see everything that we got going on. And again, if you're looking for conventional, so 4 units and under is still conventional, which is awesome because you can still get a 30 fixed. Give a call to Reed Hazard. Wonderful guy, worked with him multiple times, almost every time. Very qualified, top 100, lender in Nationwide, phenomenal guy, really knows his stuff, owns multiple properties that he's kind of acquired with Marshall Reddick, and just knows what he's doing. So again, if you have any questions, give Reed a call if you're looking for conventional loans, whether it's regarding getting a new property or refining what you got. So check it out. Okay, again, if you got any questions, here's another consultation page. I threw a couple of these in there because people always ask for consultations, and I just wanted you to have this information. So you can scan that too. But without further ado, let's go into the next part, our growing portfolio of managed buildings. We're going to talk about property management here for a second, because as I said prior, it is one of the most crucial parts to owning a multifamily property. Increasing rents, maintaining the building, dealing with non-paying tenants. That was a big one that we've dealt with for the past 2 years. We have a great track record for all that stuff. Or just turning over a building and getting it operating as it should be. Whether that looks like, vacating a unit and renovating it, raising it to market rent, or, just getting rid of a problem tenant that got inherited with the property, and that's the reason why the property was so cheap. Here is a couple of the buildings that I wanted to talk about, and these are actual buildings that we manage here at Marshall Reddick that we have turned around for investors just like yourself. Here is a 5-unit building under management in Santa Monica, 1 3-bed, 4 2-beds. So you got a 5-unit building in total, commercial building. 3 of the 5 units managed. We've overseen substantial upgrades. Now, we're not upgrading the place with the tenant still in there, because everybody knows Santa Monica rent control laws. Even if you spend $100,000 on the place, the person who's living there can still live there for the low rent. Don't ask me why. It's just, it is what it is. And Santa Monica rent control is substantially stricter than California or City of Los Angeles. There is the California statewide rent control, but we're already pretty well versed about that. And it's actually something that you can get through fairly, that you can navigate with proper amounts of education, which we have here fairly easily, right? So those $200,000 in upgrades resulted in huge rent increases. I'm talking about thousands of dollars a month. Here is a 4-unit in Costa Mesa. This one's actually like 7 minutes away from our office. Okay, 4 2-bed, 1 baths, nice solid little 4-plex, great unit composition for what it is. Actually a pretty cute little property. I know the picture's a little grainy in there, but great place. I've been there multiple times. All 4 2-bed, 1-bath units. This was a recent value add acquisition purchased with one of our agents here in the company. In-house property management to manage the existing tenants, move outs, upgrades, and leasing for huge rental increases. If any of you guys live here in the 949, it is definitely a big one to live in Eastside Costa Mesa, and rents are skyrocketing substantially. Great place to own any kind of real estate, Eastside Costa Mesa. Once you get a little further to Newport, it gets a little too expensive, in my opinion, from purchase price to income wise, but you can still make some huge net equity gains in the east side market, west side Costa Mesa as well, but really anywhere coastal Orange County. And last but not least, here's an 8-unit managed in LA, 3 2-bedrooms, 5 1-beds. This is a little bit of a bigger property. Like I said, we're talking about 3 to 8 today. We do manage bigger stuff, but this is for a lot of the newer investors, that's the range like to hang around. 4 of the 8 units have been turned. We've turned 4 of them, which if you own any real estate in LA, you know that's difficult. Again, same with Santa Monica, tenants have a lot of rights, but we were able to navigate it effectively. Managed $100,000 in updates, rents have increased, and City of LA rent control plus community investment department is stricter than California, again alluding to that. But just to let you know, if you've got a multifamily place anywhere and that you're looking for more info on, we can help you manage it. Here is all of our information. We do not shy away from posting all of our stuff. Some property management companies, they'll hide stuff, they'll tell you they'll have hidden fees, they'll have all kinds of stuff. We started off as a real estate investment company, and we adapted to a property management company because we noticed the pain points. And again, that's one of the reasons why I joined the Marshall Reddick team quite a while ago, was because of the fact that we do property management and my passion for the multifamily market in general. It is the only thing that is going to help you with that forced appreciation aspect of acquiring these value add multifamily buildings. Crucial, absolutely crucial. So reach out to me. I can get you in contact with the PM team, get you a consultation, anything about property management or current or future properties. If you have any questions that way, there's all our fees on the other side. Very, like I said, very spelled out. No setup fee, no maintenance fee, no eviction coordination fee, no fees. So very interesting. All right. So also point that everybody likes to ask is, what do these average buildings look like? What can I expect when I'm looking to purchase a building in any of these markets? 3 to 8 units, I'd say an estimation. If we're looking in nice A to B class markets, again, if you don't know what we're talking about with A or B class, look up the Marshall Reddick Property Rating ebook. I will, if you reach out to me, I can send you a PDF version, and you can read through that. Helps you communicate with regards to investment property. But we're looking at A to B class markets that we manage and operate in Orange County. We're looking at about 1.25 at the super low end for a smaller triplex, all the way up to 2,750 for a good unit size 8-unit building. Average, like I said, I live and work in I live in Huntington. I work in Newport, Costa Mesa, Huntington. Do a lot of multifamilies there. Fountain Valley as well. I really like Fountain Valley. But you're looking at an average fourplex about $2 million, $1.8 million, something like that. Sometimes you can squeak one by the buzzer and get a $1.65 million, $1.7 million for a fourplex. But those are about average prices. LA County, you can actually dip below the $1 million mark, believe it or not, for a triplex. There's actually one in Gardena that I saw on the market that I actually quite like. Needs to come down a little bit more, but the top side, you're looking at 2.5. These are probably subject to change. So, stay informed, stay in contact. I'm actually seeing huge price dumps with the market condition. Some of these multifamily places are dropping 50, 80, 100 grand in price reductions. So if you're kind of feeling frisky and you want to rip out a lowball offer on a place, be the one to set the new mark. I advise that. We're doing that a lot with a lot of our investments in Texas, Tennessee, and Florida. We're just having people ripping out offers, and we're seeing some success. We know how to navigate that. We can get an offer in for you. We can make it happen, and we can also turn it around. So that's what they always say. It's you don't make money on the sell in real estate, you make money on the buy. So now is the smart time to start looking into some investments. Cap rates, expected cap rates. These are estimated. Estimated cap rates are for stabilized, performing, and up to rent assets. That's a very important definition when I'm saying for that. Stabilized means you don't have any vacancies, you don't have severely under market rents. Performing means everybody's paying rent. Okay, that means everybody's on time, they're paying the full amount, there's no delinquencies, you're performing. And if you're up to market rent, that's also very important. Usually if you're in and around 10% of what you should be, that's still about average of what you're looking at for cap rates. And with that taken into account, this is what they trade hands at. You're looking at Orange County between 3 to 4.5 cap. Sometimes you can kind of trickle up from there, but 4.5 cap is about the max. And a 4.5 cap even comes in like B and C class neighborhoods. So Southern California real estate, there's a reason why it's a low cap rate, because values and rents don't go down. Orange County, if we're talking about a 3 cap, that's like super coastal. That's some luxury property. That is something that you would not regret owning in 30 years. You know what I mean? Some place that's going to go up astronomically, probably somewhere surrounded by $2-3 million homes, and they've got these little multifamily pockets that have these gorgeous little beach bungalows. I'm thinking like Peninsula, stuff like that. That's usually about a 3 cap, sometimes a little lower on the Peninsula, if I can be so honest. But LA County, you're looking at a 3 to about a 5 cap, and the reason why we go up to a 5 cap is because you get some other neighborhoods that are a little rougher, and they have increased cap rates accordingly. So there we go. All right. Property update. This is what I wanted to talk to you about. This is the property I was alluding to in Torrance. So we're going to see a real world example of a property that I personally sold to a client that was turned over for a massive income upgrade and, you know, increase in NOI, increase in value. This is a real example. So pay attention. Again, get those pencils out, take some notes. This is the property here. Cabrillo Avenue. It's in Old Torrance, if anybody knows the South Bay. I love Old Torrance. I grew up in Torrance. You know, it's just a super solid little city. They've got great schools, and that's really what keeps up the rents. It keeps the neighborhoods nice. It keeps it as a nice A-class asset. Okay. This property, the list price was $165,000, which we actually negotiated back about 25 grand in termite. So it's actually 1,625, but for this equation, we're going to work it that way. With a 30% down, you know, we're yada, 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 working through it. Again, this building had a vacancy in the front, 3-bedroom, 3-bath. So when you actually look at the cap rate, it's a 1.9 cap. So like we were talking about prior, any investor who's looking for a performing asset, they're just going to say, skip, don't even look at this. This is crazy. Why would you even show this to me? However, you know, if looking at the building as a whole, you've got 9 beds, 9 baths. You know, it's about a 5,000-ish, I'd say a little bit bigger square foot property with substantial upside in rents. There's also 2 3-bedroom, 3-bath townhomes behind this standalone front building. And those were currently rented, or they were rented rather, for about $1,800 and $2,000 a piece. So substantially under market rent, and then a vacant front unit. And here is some light renovations. This is what we're talking about. It doesn't need to be crazy. I know the lawn looks a little brown there, but we actually threw some weed and seed on there and cleaned it up. Flowers, floors, you can leave your windows, leave the closet, put some ceiling fans in, paint the existing cabinets. You don't need to replace the cabinets, just make it look pretty, pick a good color, put in some LED lights, new stainless sink, really minimal stuff here. Get some cheap quartz, throw it on there. I think all in all, the budget on this, just this one unit, was about $30,000, if I remember correctly. So it doesn't need to be crazy. This is even a heavier lift than a lot of ones that I recommend to other clients. Only reason why we needed to put floors is because the carpet in here was original. It was supposed to be blue, but it was some kind of shade of purple green. It needed new floors. But this place is phenomenal. We actually turned around and rented it out for $3,800 a month. Okay, let that sink in, right? 3-bedroom, 3-bath unit in Torrance for $3,800 a month. That's a lot, big unit again. But what made it appealing is another reason why I say it's important when you're looking at multifamily properties, one triplex versus the other. Look at this unit, 2-car garage attached with a door inside. You've got a big, beautiful oak tree in the front yard. Okay, it's a 6,000 square foot with a balcony on the front and a little private backyard, no shared walls, for the same price as a triplex that looks like a cube, right? I call them people cubes. There's certain buildings, you look at them, they're just one rectangle that runs the full length of the property. Not to say that the numbers can't be good on them, but usually speaking, you see better returns on better looking properties like this. So a triplex is not always the same as a triplex, even if it's right next door, because this one we earned about $200 a month more than a comparable unit because of all the factors. Okay, and here is our after numbers. So if we're taking this into account, I believe this is even with keeping one of the rents low, because one of the rents is still one of the original renters. We did raise the rent, but we're looking at a net operating income of 77 grand. Now, if you remember, our NOI before was 32. So we really did more than double the net operating income, okay? This is accounting for about 120 grand in repairs because we did all 3 units. So it was a little expensive to get the renovation done on this one. But again, like we showed you earlier, we do have a renovation plan or renovation loan with us here at Marshall Reddick. This client paid out of pocket, mainly because he was cash heavy, and it really paid off in the end, okay? So this property, even before we renovated the middle and back unit, after just a renovation of the front unit, appraised in the 1.9 range, okay? Phenomenal. This is probably a once a year deal that was a total awesome win. Now, not to say we can't get close, but these deals are out there. Even with the market and the current condition that it's in, I would say that more of these deals are out there because people are holding on to their change. They are not spending. We're seeing huge price reductions in properties, and I've seen about 2 opportunities this week. Very important that if you are in the market and you're shopping, reach out, let me know, schedule a consultation, because these deals pop up all the time. And when they do, you literally have to be on the phone in the property looking at it in the first like 2 hours, or somebody else is getting an offer in. It's just the market moves quick when there's a screaming deal, and you can get them. They're out there, right? So this, again, cap rate is a 4.7 operating. What that means is, because we acquired it at 1.6, taking into account the upgrades and everything, it's actually higher than what the market average is if you were going to hold it. But if you do a future valuation or a cap rate reversion valuation, I would say at a 3.8 cap for this neighborhood, you're at a value of about 2.4. Okay, I know they gave us the 1.95 rather for you know, just the renovated front unit, but if they were to turn around and wait a little bit longer, they could have gotten another 100K out of it. For estimation or an actual gain for this property of about a $247,000 equity gain in 90 days. So you know, forget flipping single family homes, man. I'm a big proponent of flipping multifamily. There's deals out there, you get them done. There's a lot more moving parts. You need a great team behind you. That's what we have here, but it's doable. Now, here is the absolute icing on top on this one, because you're going to get a kick out of this. If anybody has been building any kind of real estate in California over the past couple of years, the biggest 3-letter word or 3-letter acronym is ADU. This property actually had a massive garage that is being converted right now. They've got plans approved for a 2-2 ADU. What that looks like afterwards, exactly what it looks like. This building will be bringing in $108,000 net income. Of course, you have to subtract your note from that, but you're looking at the monthly income here of the rate that they locked in at of $55.85 a month. That's 60 grand a year. A year and a half after owning this building is now producing this client $60,000. It's a lot of money. That's definitely not the average. Again, this is a once a year deal. This was a great opportunity that was really taken advantage of by this client in a really good way. But it's doable. I mean, even if you've got a place and it's making you an extra 20 a year, an extra 10 a year. What's really expected in California when you acquire a property is for it to break even for the first year, which we can normally do by just getting rents up to market rate. This one obviously is a more forced appreciation because he did substantial renovations in the back 2 units and built an ADU. But even if this is a 5-year plan, a 7-year plan, just get the building now, because even in 3 years, you're going to be raising rents about $50 a year, $100 a year anyways. So when you multiply that over 4 unit, you know, that's $1,200 per unit. So you're looking at $4,800 a year of just extra cash flow, extra 5 grand. It's crazy. So we are going to go over another property, again, a real property that I had sold to a client this January. It is a 4-plex in Huntington Beach. This is more like a more realistic sale that we see. You know, the Cabrillo property is a once a year deal. This is probably like a twice a month deal. These things pop up all the time. You just got to find the right place, the right time with the right deal. This is actually a deal that I put together off market for this client, which is, here you go, 16842 Hoskins. We actually just signed the lease for the 3rd unit that we had vacate, which is the 1-bedroom unit. But this is what the numbers look like on acquisition. 1.8 mil, current rents 86 grand, NOI 37K. Not the best. 2.06 cap rate. Nobody would buy that. Nobody would look at it. it is definitely a value add. Don't let the front deceive you. It was very pretty, all the palm trees, water taken care of, nice touches here and there. It had a lot of work to be done. You know, we completely renovated the D unit all the way in the back, the 2-bedroom, 2-bath, and then we did a touch up on the A unit as well with a you know, flooring and paint and renovation and cleanup. The initial repair cost on this was about 75 grand. Again, these clients had paid for it out of pocket. However, there is the renovation loan that we can handle on that one as well. So here is the work done. This is the back unit. This is the unit I was talking about that was completely renovated. Looks a lot similar to the Cabrillo place. Doesn't need to be super expensive. You don't have to put the best finishes, but there's little things that we know how to do, or little design touches that we've learned from managing all these units over time in really great neighborhoods that we know. Just the little touches make it look a little bit nicer. It'll get you a better quality tenant, 50 to 100 bucks a month more in rent, and it's really well worth it. So you can see, beautiful, really clean. This place leased out in, I think, 20, 30 days, whatever it was, way less than what's expected. And we had tons of applicants. Great property. What makes this property appealing again is if you see the building, you can look, it goes back. It has a front patio and a back patio and 4 one-car garages. So even the 1-bed unit has a garage, and all the units have laundry. I know that doesn't seem like much, but believe you me, that's a big deal when people are looking for a place for it to have laundry. So here is the renovation upgrade, 75 grand. After rents, 130,000 for an NOI of $75,000. Okay, that's positive cash flow, about 380 bucks a month. Not much, but like I said, break even point. When rents go up next year, we'll go up another 4 or 5 grand, right? For a future valuation, I know this neighborhood is about a 3.5 cap of 2.147. It actually had appraised for about that right shortly after they purchased it as well, for a $347,000 equity gain. That's a lot. It's all doable. Like I've said many times, a ton of moving parts. I think it took about a 6-person team to really get the gears moving to get all this work done within a short time frame, which we made happen, which we always make happen, which we have that level of professionalism here at Marshall Reddick, which we want to do for you. All right, buyer or seller representation, right? It's very, very important that you schedule a consultation. Reach out to me. Get to know me. I want to get to know you. Reason being is because we look to build that relationship. I get a lot of people who are looking. We get a lot of people who inquire, looky-loos. That's why I say I find it personally. I take it as a personal task to connect with each and every one of you, because I want to make this personal. It's we are strangers over the internet, and I want to bridge that gap and get to know you. I want to be your real estate advisor. I want to be somebody who helps you for the rest of your real estate investing career. And even, if you want to branch into it, maybe your kids' portfolio, we'll take care of it. We're all about that generational wealth. We're all about building those relationships. We're all about being your advisor for life, right? Come in for a one-on-one consultation. We can have the over the phone or over the Zoom consultations. Great for an initial meetup. But if you're anywhere within 45 minutes to an hour of our office, come meet me. Come meet us. Come see the team. Come meet the team. We've got the whole property management team here, the whole private lending teams here. It's actually quite a fun little office that we got. We'll make you a coffee. I'll take you out to lunch. We'll get to know you. We'll make it happen, right? I also wanted to allude before, like I said, be prepared and need for speed. That's where the first 2 things are important, that we've got all our ducks in a row, that I know exactly what it is that you're looking for. You tell me, hey, Tom, here's my budget. Here's what I want. Help me find it, and I will. But when I do find that, you got to be ready. You got to have your pre-approval. Got to be good to go, because I will definitely have already called the agent before I call you and be providing you the information of what my recommended sales price or recommended offer price is going to be. And we're going to contract, and it's going to be quick, man. But it's awesome. It's awesome to get these deals. All right. A lot of people always ask, how do I find these 3 to 8 unit properties? Either they're trying to find them themselves, or they're just curious. For this type of asset, many deals get put together off market, like that Huntington Beach one. What does that mean? That means that I'm spending way too much money on marketing. I am, sending out mailers, good old fashioned. I door knock. I get to know a lot of these owners personally. Like that recent sale, that's actually my neighborhood that I live in. So I knew the owner personally and we put that deal together. But it is really just, it comes from networking. Anybody in the office that has a client that comes with a multifamily property, they usually bring it to me. I'm the first person that usually has quite a bit of people because I'm so passionate about it, because I connect with people like you that are here tonight, and we offer these deals to you first. Networking referrals, that's what I just said, but competition is stiff for listed properties. Not to say that deals don't come from the market. Cabrillo was listed on market. That was a deal that got put onto the MLS, but because, again, I get my updated search that pings my phone at 4 in the morning that somebody listed something at 4 in the morning for whatever reason, I look at it because it's worth it, because I can make you guys a lot of money, and it's what I love doing. It's really what I love doing. It's kind of fun. Competition, like I said, is stiff. That's why you got to be ready to move and make the deals happen. If you have a consultation with me, you tell me, hey, Tom, I want to buy a place in the next year. Let's do it. Let's do it. I will hold you accountable, and you will appreciate me forevermore for holding you accountable. I will be your accountability buddy. I will help you grow your real estate portfolio exponentially, 3 to 4 units at a time. It's going to be fun. So a little bit of FAQ. I'm actually going to go through, we're kind of short on time. I'm going to go through the FAQ. I've got a couple questions in here. So I will get back to you on the questions via phone call or email. But here's just a little broad FAQ. If I own a multifamily, I self-manage, can Marshall Reddick help? Answer is yes. We can definitely help. That's actually kind of a specialty that we've been noticing. We've been falling into niche-wise. A lot of property management companies are either mismanaging or somebody's self-managing a building. We come in, turn it around, get good tenants in there, somebody who's not going to be bugging you, somebody who's not going to be putting complaints in, or gosh forbid, lawsuits. Bad tenants equal problems. You don't want bad tenants in your building. You want a good manager who cares about you, who cares about your building, who cares about placing the right tenant who's going to be a good fit. I'm scared of rent control. Is multifamily safe? Again, yes, we are well versed in the California statewide rent control. If you've got a tenant in a place and you want to move them out, they can't dig their heels in the way they can, like in Santa Monica and LA County. If you have it's called a not at fault eviction. Essentially, hey, I want to renovate your place substantially. Here's a credit for 1 month's rent, bada boom, bada bang. And as long as you follow your timelines, you have all your proper paperwork, you can do all your documentation, which we know and handle very well here at Marshall Reddick, it's quite easy. A little bit of extra vacancy versus some of our Texas or Florida properties, but it's doable. And trust me, the numbers pay out way better here than there. I'm contemplating a 1031 exchange. Can I exchange my single family into multifamily? The question again is a resounding yes, as long as it's an investment property. Now that's the most important part. If you inherited a property and you have it as a second home or it's under your wife's name, that's not technically an investment property. It might still be good though, because if you have it inherited like that, you might not actually have to pay capital gains, which is the whole point of the 1031 exchange. But if you have it as an investment, say you bought something with Marshall Reddick, you've got 200, 300 grand in equity and you want to translate that into a multifamily property here locally, yes, 100%. You can totally do that, and we can make that happen, and you can step up massively. You can take a place that's bringing you 2-3 grand a month and turn it into a place that's bringing you 10-11 grand a month. It's pretty sick, pretty awesome. I'm concerned with the market's current status. Should I wait to buy? Surprisingly, it's kind of it's a sort of a yes and no question, right? So as an advisor, I wouldn't advise buying the way that people were buying over the past 2 years, just kind of picking up stuff willy-nilly. I mean, anything was getting picked up by anyone for any reason. So definitely don't jump at everything. But this market environment is positioning us, is giving us this interesting position of these deals popping up. And the deals still make sense, even though we're at, 7.25% interest rates. They make even more sense because as long as you buy a good deal, you get it stabilized, and then you go refinance when we're back down in the 3s and the 4s, you're walking away with a huge chunk of change because you bought the property at a distressed time. I would say that we're in a distressed market in real estate where the people who are selling need to sell. They don't want to sell. They're probably locked in at a super low interest rate. But that doesn't mean that deals aren't out there. So things are still happening. Things are still moving, not nearly as much. I would advise don't go buy any old real estate deal, but the Choice Select ones jump. They're out there. Last but not least, the Learn page. If you're a little too shy to schedule a consultation, I get it. But although, like I said, there's no such thing as a dumb question. I come from a family of educators. My grandma, my uncle was a superintendent. My mom's a teacher. Like it, I enjoy actually helping people learn things. So don't feel shy to schedule a consultation, even if you're just asking how to use the Learn page. But the Learn page is a very valuable asset. We have educational videos, articles, guides, you name it, it's there, including the Marshall Reddick ebook. Go check it out. You gotta look at that. That's the #1 step if you're gonna be working with us here at Marshall Reddick. Super basics, like 16 pages, really easy. Scan that QR code. That's gonna take you right to the Learn page. You can really get down a rabbit hole for whatever you're really looking for, whether it's 1031s, taxes, buying real estate, different markets. You can see my past presentations that I've done on multifamily real estate. Super interesting. Look at it. Also, pop over to the Invest Real Estate tab as well. You see it up there. Look at some properties, check some stuff out, run some numbers, analyze some deals. And last but not least, as I've said prior, this is the most important part. Schedule a consultation. I personally take it upon myself to try and connect with every single one of you that attends. You took time out of your busy schedule. I want to take time out of my busy schedule for you and ensure your financial success and your real estate goals. The #1 way to succeed in any industry is communication. That is so true. So communication, keep lines open. Let's chat. Let's communicate. Let's have a real estate conversation. Come on into the office. Let me get you a coffee. And let's do some deals. Again, my name's Tom Ahola. I'm the an advisor here, the multifamily specialist. That's my office number, 949-885-8168. tomahola.com/Marshall Reddick, or tomahola.com @Marshall Reddick rather. Or last but not least, scan that little QR code. Thank you so much. Thank you for taking the time this evening. As I said, there's a ton of information. So keep it in bite-sized chunks. I will, I'm going to be reaching out to you. I see your questions. I would love to answer your questions, but I got to run. So we will get back to you, and I look forward to connecting with every one of you. Thank you much.